Hello and welcome to the latest Wealth of Advice Retire Well podcast. Today we're going to talk about investment options, looking at what can be held within a pension and walking through the basics. I find often when people come in and we're talking to them about pensions and investments, it can almost be back to basics as a good starting point. And I think that's where we should start today. How does that sound for you?
Yeah, I completely agree. One of the sort of common themes in my first meeting with clients is people come in and say they want to invest, they want to improve what the pension is going to be like in retirement, but then they don't actually understand the underlying investment options there. I think it's a really good place to start. I guess the best place to start off with looking at what underlying investment options you have is to sort of have a little bit of a conversation with risk and reward and sort of how that works within an investment portfolio.
Yep.
Do you want to go ahead and start with that, Matthew?
Yep, no, that makes sense. I think the ones that people can understand well to start with is the idea of investing. So the idea of having some money and saying, I'm going to own part of Tesco's, I'm going to own part of HSBC, I'm going to own part of Microsoft and Nvidia. That is shares, equities, whatever the buzzword people want to use. That is the bit that people start to understand with investing. The harder bit for people to get their heads around is to say, okay, I've got investments like those equities, like those shares, but what's the other bits that come around it? So debt is a common one where people say, why do I want to invest in debt? What does that mean? So the buzzwords for that tend to be bonds or gilts, and that is where you are investing money by giving it to a company or a country in exchange for that regular income. So do you want to go through almost the differences between holding a company and holding some debt?
Yeah, absolutely. So as Matthew said, the easiest to understand there is equities. And when you're looking at sort of the risk versus reward nature of them, bonds are generally seen, or bonds, fixed interest, gilt, whatever you want to call them, are seen more on the lower end of the risk spectrum, with equities being a little bit higher risk. So to start off with equities, it's essentially, as Matthew said, you own a portion of the company. In most cases, particularly with a larger one, it will be 0.000 recurring % of that company. But essentially, it's you having ownership of it. If it does well, if it has good financial results, the stock price will go up, and by proxy, your investment will go up also. Bonds and fixed interest is a little bit more complicated to understand for most people. If me or Matthew were to want to borrow money, we'd probably go to a bank and ask for a loan. They'd then give us an interest rate that we're paying the loan back. When large companies or even governments want to raise money, so that might be to, if a new company wanted to break out into a new market or a new geography, they might want to take multiple £1 million and issue a bond which you can then buy. Or equally, a government, if they wanted to fund services in a way, they would offer a fixed interest gilt where they can essentially, they're given an amount of debt, they will then pay you a fixed interest for you servicing that debt. And the reason why they're essentially seen as really low risk is because it's very unlikely if the government is going to default on the debt, because it would need a total implosion of the government. Which we've got bigger issues on our hands, and then companies are obviously more likely to fail and therefore default on the debt. Therefore, they're actually seen as slightly more risky, I should say. But the drawback on that is, or not the drawback, the vice versa on that is you're actually given more return through a corporate bond as opposed to a government bond.
Yep, I know that makes good sense. So from a risk to reward point of view, what is the risk-free option? So most people would say the risk-free option is holding cash because, apart from a financial institution going bust and you would get some compensation back, what is the risk of holding cash? Then when we look at investments, you're then saying, where is the reward above that from taking the risk? So the idea of company values fluctuating and sharing in that volatility of holding Tesco's, Nvidia, those sorts of companies, that is riskier, on paper than debt, because debt has a fixed rate of return. Yes, as Joe described, a company could go bust and then not repay all their debt, but as long as you're talking about big companies issuing large bonds, there's going to be that sort of known entity paying it back.
Yeah.
So if
just to stop you there, just while we're on the sort of topic of risk and reward, you mentioned cash is inherently not risky. One of the things that I think, again, is not really understood when it's starting to come into investing is the risks of holding cash when inflation's going up. So over the last few years, we've obviously had quite high inflation, up to sort of 10% at its peak. When you hold cash, it will obviously have a return that's guaranteed, so you won't lose value. You won't have less cash than you started with, but the buying power that cash has will reduce as inflation and the cost of goods increase.
Yeah,
Sorry.
Good point. And I think the same applies with bars of gold. Again, in the past, I've had people who say, I've read something in the Telegraph, I think holding gold is a really good idea. And they say, well, how can I put the whole of my pension into gold? Again, we can talk through how that doesn't work and all the sort of problems with it. But if you just think about a shiny bar of gold and you put it under the bed, where does the value increase from, or where does the income come from? With the analogy of holding an investment in a company, they're sharing their profits and you're getting some of that reward as a holder of the company. With the bar of gold, you aren't seeing any income produced from it. All you're ever going to see is changes in the price of gold. And if you then went to sell it in the future, you might get more than you bought for it. So that's almost the one way of looking at it, to say, am I holding something for the price to change, or am I holding it for it to produce a return such as interest or income? And I think, again, it's understanding why someone wants to take risk in the first place. So if I was to walk in the door today as a new client, not understanding my pension and not understanding risk to a lot sort of a greater good, what would the questions that you would want to ask me to understand, my situation?
Yeah, so generally what we do sort of coming in, we'd have a general discussion on goals and objectives, and through that we'd find out sort of how much would you need in retirement, or is there a future capital purchase that you're needing to take, and how far away is that? I think that's a really big bit of the risk versus reward spectrum, because the longer that you have until you need to do something, the more that you can sort of almost facilitate the investment going up and down, because you've got a longer time to essentially wait out the lower bits and hopefully have it going up longer by a greater amount, in the future.
Yeah, we had a client conference last week, and a great question was asked to me there where one of our clients said, on the charts, the more risk you take, the better the portfolios have done. And his question was, well, why isn't everyone in the top risk portfolio? And he's not in the top risk portfolio, so he knows it was a bit of a trick question from him, really. But in simple terms, the time frame for investing and the psychology of the investor is what limits the level of risk that someone's willing to take. So when we think about retirement, for most of our clients, they've worked very hard to build up a pot of money, and they then want to feel like they've had good value in retirement. So they want to take an element of risk, and they want to take, more equity risk than not, to try and have those returns over the long term, but they don't want to take undue risk. So they're not saying 100% equities, they're saying a balance between equities, bonds and alternatives to try and have some more stable returns. And I think it's that bit that, the client's question was, should I be taking more risk? Should I be going for that top risk portfolio in order to get more returns? But if the first year that person had been a client, or the first year that person had been invested, was a 2022 year when we saw high inflation, Russia, Ukraine, Liz Truss, lots of problems in the economies all pushed together to cause volatility, that person might want to hide under the bed and ignore the real world scenario because of the worry that their funds would run out. And again, things like COVID, a great example where the investments fell heavily because there was so much uncertainty in the world. And if the person in that situation had said, well, I want to take no risk, I want to press the button and sell all my investments within a pension, for example, that would have been the worst decision possible, because over time, quite quickly, those investment returns came back, but someone had to be willing and have enough capacity for loss to tolerate that change in plan.
Yeah.
Did you want to perhaps touch on capacity for loss and how that works?
Yeah, absolutely. I was just going to mention what I think I find summarizes risk and how you can, what's right for yourself is what I refer to as sort of almost a risk triangle. So it's the three things that you need to make sure that you can take that level of risk. The first one obviously is your ability to take risk, as you've touched on there. Do you have the funds to, if your pensions do go down or your investments do go down, do you still have the funds to live the life that you want to do? So that's your ability to take risk. Then you want to look at the need to take risk. Do we need to sort of blow the lights out and shoot for sort of record returns? Or are our retirement objectives actually pretty close? And do we need just maybe a good example of this would be when you're actually in retirement, you've built up all the capital that you'll potentially need, and you're essentially just looking at maintaining the value of your fund while you're drawing down from your pension. And then the third one, which is often overlooked, is almost the want to take risk, because you might have the ability, you might almost need to do it to get to your goals. But as Matthew said, if you're not comfortable with those big drops during COVID and you're not happy in sort of risking your money like that, then there's not really much point in taking the risk at all.
Yeah, I think that's fair. I think often we see people who've taken a lot of risk, possibly, business owners who've taken risk to get to the funds, and then they say, oh, well, I've taken my risk. I don't want to have investments, in high equities, or I don't want to take extra risk because I've done the hard work to get here. I think we also find as people have been invested for a while, their confidence increases, their understanding increases, and they can also almost say, I can tolerate more risk now. So I think for us, we're definitely working through education with clients, understanding so that they psychologically are more confident. When you live through a COVID time, you will have the uncertainty, but then going forward, we're now 5 years from COVID, you can reflect on that and say, what actually happened, and was I worried, or was I rightly, trust the process? Equally, there's been years like 2022 where with Liz Truss, Russia, Ukraine, high inflation, all those things we've just mentioned there, that made being an investor and having a pension that was invested quite a difficult time because of volatility. But it depends how often you looked, and it was really only a problem for someone who was wanting to retire, in that moment, and psychologically couldn't tolerate the volatility. For everyone else, there was an element of, well, we're going to come through this, and actually I can just trust the process. Do you want to perhaps touch upon the level of risk that someone's willing to take in retirement compared to when they're saving and putting money in on a monthly basis?
Yeah, absolutely. So just before we do that as well, when we're speaking about risk, I realise we can almost jump into jargon and running very much when you're looking at portfolios, the risk will essentially translate to almost how much equities you put in the portfolio. We'll touch on that in a little bit, but in terms of what Matthew asked with regards to sort of accumulation, and then there I'm talking about jargon, but in terms of saving up before retirement and then pushing after retirement to then draw an income, generally we see people that are sort of pre-retirement looking that they can take more risks, particularly as Matthew said, when you're saving on a monthly or regular basis. And the reason for that is because since you're putting money in each month instead of essentially putting, let's say, a lump sum in on 1 month and then hoping that from that point the market's forever going to go up or not drop, in another case, each time you buy a monthly investment, you're buying up the price for that month. So if you put £500 in on month one and it goes down to £400, that's a large drop, but just trying to make the numbers easy for myself. You're then actually buying the stocks or whatever investment it is at a discount, which means the next month when it hopefully goes back up, you're essentially getting more of a gain on your investment than if you put everything in at once.
Yeah, I think to try and be as simple as possible with that, I think when you're saving money and you're investing money and you're accumulating, risk and volatility are your friend.
Absolutely.
Because, as you say, you might be buying here, you might be buying here, you might be buying there. The smooth price is the average that you pay. At the point when you're then ready to retire and your plan all works, then you might say volatility is no longer your friend, because you know that in the same way that you were putting the money in on the different months, you might then be taking money out each month, and you don't want to have the same change in value on a regular basis. You want to smooth that down. So some people might say, okay, I'm more speculative when I'm saving, and then I'm willing to take less risk in retirement. In reality, what we find is people also get more comfortable throughout the process. So the theory of taking more risk and then reducing it doesn't always play out. But what we do is we say, if you're taking money out of a pension on a regular basis, you might want to have a section of that in a low risk asset, such as cash, so that you're taking money from your income bucket, and therefore you are smoothing your own risk. So again, we're jumping into jargon. It's an industry full of jargon, but basically it's about knowing the risks, understanding the risks, and then actively deciding what's the right level of risk for yourself.
Mm-hmm. Yeah, absolutely. So I think there's only one sort of real other asset class that we haven't spoke about. We maybe spoke about it recently before we sort of look at almost the makeup of a portfolio and how they can all interact. But alternatives, Matthew, do you want to have a quick run through alternatives?
I think alternatives, and then property again is another one. We tend not to talk about property as much because certainly in the last few years as an investment within a pension, it's become less popular. But it used to be, one of its own pillars, and now possibly gets grouped into alternatives. In a simple sense, equities is owning and sharing in the value and the income from a company. Debt is lending to a company, and then alternatives is anything that is not those. So it could be commodities like, oil, gold. It could be property, or it could be sort of finance or other clever instruments. And what we're trying to do here with investments is to say, we want your pensions to behave in a way that dampens volatility while still producing positive returns. So if we imagine all of those asset classes as performing slightly differently in different conditions, we're hoping that we can almost smooth those returns. And if equities go up and bonds go down, you're trying to find something that almost doesn't behave like either of them, so that almost like stabilizers, you want every part of your investment to be heading in a positive trajectory, but you also want to have stabilizers to keep your returns on a positive basis. Property is a funny one, because when people think about their own house, they might say, my house is my castle, and that's a great investment for me. That makes 100% sense. When you think about a property investment in a pension, you could be owning part of the metro centre. It could be, a large commercial property. And then you might say, well, what other risks am I subject to? And it might be, how's the economy doing? It might be how companies are being taxed. It also might be investments in things like data centers. So you might be sharing in positive returns from the likes of Amazon. So really, it's just seeing how those returns work, and it's the correlation. You're trying to have assets that behave in a different way to reduce your risk going forward.
Yeah, absolutely. And on that property, like Matthew said, it's almost accessing stuff that you normally couldn't with your own cash. You could go down and buy a house for a buy-to-let or something like that, but it's unlikely that you could sort of just go away and, like Matthew said, buy a portion of a commercial property. And with them, especially in retirement, if it's sort of a large sort of high-value commercial property, that is likely to sort of pay in a similar way to what bond or fixed interest would, in sort of a fixed amount each month that can be pretty reliable for income purposes.
Yeah, so let's jump into some of the sort of common questions we get. So as a low-risk investor, I have a pension, but I don't want to take any risk. Can I hold it all in cash, and should I?
You can. Would it be the most recommended thing? Probably not, for a couple of reasons. One is, as we sort of mentioned earlier, cash, although it's great, it won't. It does have a place in financial planning. It won't reduce its capital value, so your cash won't drop down. The issue is there with inflation, especially being what it has been in the last few years, is essentially the value of that cash, the amount that it's able to buy, is going to sort of reduce over time. And if you are wanting to take a certain income out, you're essentially going to be starting to erode your cash value.
Yep, I think that's fair. Also, a pension, unlike a bank account, does have ongoing charges.
Absolutely.
So as well as inflation, you're also going to have charges eroding that value. So ultimately, if you're going to take an income over the long term from a pension vehicle, you do want to take an element of risk. It's then important just to understand what you're comfortable with and the risks involved. People often say, okay, walk in the door, I don't know what level of risk I am in with my pension. I think I'm just in the default one. What should they think about, or what should they worry about?
So default funds in a pension is an interesting one, and I'd say something as passionate as I can get about them is if people don't review sort of the default options in the pension, they could be in a sort of a really detrimental place. I was looking prior to the podcast, and over 9 in 10 people in workplace defined contribution pensions, which is the most common type of pension that people in the UK will have, are all in that default portion. And if you are one of those people, you're likely to be in something called a lifestyling fund, which we'll touch on later. But the crucial part of them is 45% of those funds fail to outperform the respective benchmarks. And the benchmark is essentially what it sets, and that's its goal. So there's a high chance that if you are in a default fund, you could potentially be underperforming. And that's something that you can review. Why the underperforming could be for various types of reasons. But one of the reasons, especially when you get closer to retirement, is that most of these default funds are in what's called a lifestyling fund. So a lifestyling fund is not necessarily a traditional sort of portfolio where you will invest in, for example, 60% in equities and 40% in bonds, and then it'll be like that for the entire time you hold the investment. What a lifestyle fund does is it tries to fit your average person, in the fact that you want to take more risk, as Matthew said, when you're in your younger years, and then the closer you get to retirement, you might, or at retirement, want to reduce down your risk a little bit. The issue with the lifestyle funds that I see is that they very much, although the newer funds live in the past, in the fact that they expect everyone to purchase an annuity. And what do you think the sort of issues are with that, Matthew?
So my biggest problem with a lifestyle and fund is the time frame that they're looking and caring at for the individual. So I think lifestyle and funds are always looking at from now up until retirement age, and that's when they care about you. And at that point, they split you out at the end, and that's up to you to then decide what to do. Where we look at risk for clients, we're looking at for the whole of their life. So we're saying what's an appropriate level of risk for you for a whole journey, whereas a default lifestyle and fund is saying our responsibility is to manage your risk from here up until retirement age, and they'll automatically do something. The problem with something being automatic is it's not listening to the market, it's not listening to changes in the environment, and then there's the issue with suddenly this year is different to last year or the last 10 years, and someone has an unknown impact. Lifestyle and funds were introduced when things like 9/11, where people in America said, okay, how can my pension be suddenly worth less after a world event like that I wasn't in control of, and now I can't buy as much of a guaranteed income in retirement, which is that annuity that Joe described. So those insurance providers said, okay, how can we fix this? And they thought, okay, well, if we have an automatic system where we de-risk, if an event happens like 9/11 and someone is at retirement, they're in mainly cash and low-risk assets, they'll be less impacted than the person who's further away from retirement, who's in equities, in company holdings. So in theory, that makes sense. But then if we look at recent history, where we saw, 2022, we saw Russia, Ukraine, we saw that high inflation, we saw interest rates go up. Who did that really impact? The low-risk investor, the person with a lot of debt, because that's fixed and the interest rates were changing so quickly, the person who had already, lent money in a debt instrument was unable to adjust and unable to benefit from those changes. And I saw, someone in a default fund at that point who described themselves as low risk, and the portfolio they were in was low risk, but the fund had fallen by 20% in the year, which definitely isn't a low risk outcome. So I strongly urge people to look if they're in a lifestyle and fund and just understand it, because if you understand it, then you know how it's reacting and you can say, okay, well, yes, that's how it should behave. If you don't understand it and something comes along like we've seen with 2022, you could say, well, that's not how it should behave. People then will say, well, who to blame? there isn't someone to blame. It's an automatic mechanism.
Yeah, absolutely. I think that actually segues quite nicely into a new section that we thought we'd bring in, because we've had a few questions in, and also just general experience from me and Matthew in client meetings where there's almost been a bit of a misunderstanding. So we're going to be looking at a few retirement myths.
And if it works well, we might even get a jingle.
Yeah, who knows? So this one's very much actually in relation to how lifestyle and pensions work. Most people, when they get through an annual statement from a pension, they'll have the fund value, charges, how it's performed over the last year, and then they'll have something of sort of normal pension age or retirement age for the plan. And a lot of people come to us and they go, well, I've got mine as 67, sometimes even 70, and they go, am I not able to take anything out with this pension until that pension? Do you want to run us through that, Matthew?
Yep, no problem at all. I think the problem there is the sort of how often do pension providers communicate, and there's such a focus on, normal retirement age. The real answer with the defined contribution pension is once you pass that minimum age, so currently 55 going up to 57, that pension world then opens up to you, and you have the ability to access that pension when and how you want. The problem is, as you say, statements come through and people get hung up on a future date and thinking, I can't do anything until then. It's very rare in a defined contribution pension that you do have to wait till 60 or do have to wait till 67 to access benefits. When you've got to 55 or increasing to 57, you can say, I would like to take some tax-free cash from a pension, I would like to take some taxable income from a pension, or I would like to think about giving that pension away to an insurance provider in exchange for that guaranteed income. And another thing that almost plays into that as well is state pension age. Some people go, I have to work until state pension age because that's the time when I can access my pension. Again, sometimes that's because a private pension, a defined contribution pension, has had a similar age set up on that, but you don't have to wait at all.
Yeah, absolutely. No, I think that was a good one to cover off. As Matthew said, if everything goes well, we'll have a nice jingle for that one at some point in the future.
And feel free to send through any questions that you've got, any more, myths and anything that we can cover in future episodes.
Yeah. So I'm sure we'll run through sort of the risk reward spectrum in future episodes and how it links to different types of products that you can do. But to summarize I think it's looking at sort of the more risk you take, the potential more reward is out there, but it's very much down personally to you on sort of how much would take given your circumstances. Do you have anything else to add for this episode, or Matthew?
No, I think that's a good takeaway. I think the main thing I would encourage is just to look and understand the risk that you're taking within your own pension, and then you can start to say, should I take more risk? Should I take less risk? But it's an active choice, and I think it's that active choice that's really important.
Fantastic. As always, if we've got any questions, feel free to send them in. If you want to subscribe and leave a review, we've now pretty much set ourselves on a weekly release on Tuesdays. So the next episode will be out next Tuesday. Thank you very much.